Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. I've got a new chair that I'm trying to sort out here in the office. So far, so good. All right, so let's get to it. Happy Wednesday, everybody. We're taking a look at what's going on here today as we embark on this Wednesday trading session, and it is not without some FOMC speak. Remember, we have the G20s going on. We will have different central bank speakers. And aside from that, at 10 a.m., we've got Barr, 11 a.m., we've got Cook, and at 12:15, we've got Bowman. These could be important because unlike previous meetings where the expectations for the rate cuts were set, and you can see here, it continues to be a little bit better than a coin toss. Right now, we're still hovering in the high 50s. Yeah, same thing. Basically, 60% chance of the rate cut, 40% chance of a hold. And really, to have clarity, in order to have the kind of confidence that investors and traders want that the rate cut's coming at this next meeting, that 425 to 450 column, which would represent 25 basis point cut, from where we are now, obviously, that needs to be up around 80. And it was up around just below 80 before Powell spoke last week. So that's how important that speaking engagement was. Obviously Powell is far more important than any of the other FOMC members, but in any time of uncertainty, any clarity would be welcome. And that's kind of where we sit in terms of expectations on rate cuts from the FOMC on the 18th. All right, so what do we have going on here in the equity markets? I think I talked about this on Friday. Dips happen, right? Dips happen. And how do we define a dip? Dip could be a pullback, retracement, reversion, use whatever wording you'd like, but in the context of overall directional bias, preferably a trend. When we do pull back, if we can define what is a mean reversion, is a pullback, is a retracement, I'm going to typically use my daily price movement ranges for that. I'm going to use my top tier wave for the support of the mean reversion. But if we can do those kinds of things, chances are we'll bounce from there. And that's exactly what happened between the 15th, 18th, 19th. That's the ES. And it's not the ES alone. You could see the same thing on the RTY. Yesterday, we made a mean reversion. Yesterday, we also hit the daily price movement range. And there you go, a little bit of a bounce. I would love another shot at 2,300 on the RTY to get long IWM. There's been a number of symbols that we've persisted in focusing on these past 2 weeks. And there's a number of other symbols. I talked about them in the premium video yesterday. And also I talked about the sectors, which is also really important, in the free video yesterday. And we continue to have sector leadership in a number of places. If you're not looking at the stocks that are heavily weighted in the indices, and if you're not looking at the stocks that are heavily weighted in these sectors, right, we're going to miss out on those continuation plays, on those buy the dip plays. Why do we buy the dip? Because A, it's less expensive. It's a better risk reward. We don't need to have as ambitious an initial target. In fact, when you buy the dip, all you need is price to retrace a zone on the chart that it's already been willing to go to, unlike buying at new highs, which is kind of a hope and a prayer that you're not the last person that wants to be buying at those elevated prices. So that's the way I look at the difference between a trend where the continuation is probable and buying the dip allows us a lot of advantages over buying into strength. And, look, it's a lot of preference. There's no harm in waiting for strength if that's what you need for confirmation. But for me, that starts to skew the risk reward ratio slowly out of my favor. It increases the cost of the option and it reduces the reward. So those are things that I'm really not looking to do. And so I stick with that buy the dip. And the buy the dip will typically work in places where there's already clarity, where there's already an uptrend. JETS, which is probably most related to the IYT transports ETF, continues to behave in a pretty great way. We had, you can see here, I believe Delta Airlines Investor Day is today. And You can see what happened yesterday as we got into the investor day. Definitely a buy the rumor type scenario. And they, for the most part, have pretty good news. This 50%, by the way, is the last major move from the low of the 4th to the high of the 14th. That was a quick pullback, and I do mean quick. You can see here, this is all pre-market, but we want to stick with the long side, mostly of these strong airline stocks in the JETS ETF. Another one that I continue to like, another sector, we've got exposure here by way of Schwab and Wells Fargo. We're taking a look at XLF. We're taking a look at a sector that likely is anticipating some deregulation, is definitely a big reason why the S&P is keeping up pace with the NASDAQ. It's the number one weighted sector in the Dow. It's a really important sector for S&P and Dow traders. And it's had, obviously, as you can see, a really bullish reaction to the election. And then it's just sort of flattening out. If I have a zone like this where I've got a narrow channel in an overall uptrend, it's pretty easy. You can buy the lower end of the channel, you can buy the daily price movement range, or you can buy different stocks that are also in a trend that aren't quite as stuck. Schwab's been definitely something on our radar. Wells Fargo is something we want to continue to focus on. Bank of America is another one. I mean, these are names that I've been talking about for a really long time. None of these names, hang on, adjust this chair. There we go. Oh, I'm really tall now. So this is a chair. Hang on, sorry. I feel like I have to fold myself in half here. So I've got this chair. I call it a meditation chair. So I can kind of sit Indian style in front of my, that's what I call it, in front of the desk. I'm going to see how this goes. But right now it's a little bit of a contortionist act to make it work. All right. So if I take a look here at what's going on in financials, I don't want to neglect regionals. Regional banks have been really, really good as well. KRE, this is one of the primary reasons the RTY has been as strong. It's probably the most significant sector in the Russell. And if I'm taking a look at why KRE would be an important stock to watch, A, it's uptrend, and B, it's weighting in the Russell. So definitely we want to continue to keep an eye on the long side of the Russell. But I like the KRE better. So if someone said, Rog, Russell or KRE, but I'd be open to buying either one. All right. Okay. Jazz has a question on Honeywell in the XLI sector. Sure. So let's do this. Let's crack open the XLI and take a look at the stocks within it. I haven't updated this one, but it should be pretty much up to date. I haven't updated it. It's been a week, but it should be pretty much where we need it to be. Do I like any stocks in the XLI, including Honeywell? Honeywell is not a no, but I like ETN or ADP better. If Honeywell can get down to this previous, I'll show you right here. If Honeywell can get down to the previous Darvis level, it's not a bad setup. That's not going to be until about 223. I would say anywhere between 225 and a quarter to 223. But I don't really love that setup. In fact, XLI is a good sector. It's a great sector. Honeywell is a good stock. It's not like ADP and a great stock. But if I take a look at the weighting of XLI, this is the list of all the sectors that are stronger than outperforming the XLI. So it's not as if XLI is a no. It's really more along the lines of all the things that I could do, would this be the sector and would those be the stocks that I want to focus on? Honeywell, again, is not a no, but I prefer a trending stock in that group. All right. So thank you for the question. I would say ADP would be a better, if there's liquidity, it'd be a decent mean reversion type setup. All right. Moving on over to, I mentioned KRE. So a couple of the stocks to keep an eye on in this group. And by the way, if you're looking for a systematic way of building a watch list that has symbols within it that have the highest probability of follow through, consider looking at relative performance. Relative performance means performing, right? The performance part's easy, but relative to what? Relative to each other, relative to the sector, relative to the importance within the indices. And if we focus on those kinds of names, and I look at something like KRE, you look at regional banks, you look at Zion, you look at the Russell, these are all really good names to focus on and look for a follow through. And if we're thinking about the window dressing season, and I look at KRE up almost 11% month to date, November alone, and you think about what are those sectors that are likely to benefit from end of year window dressing. And by the way, what are the sectors that are going to be affected by end of year tax loss harvesting? Look at the top of the list and look at the bottom of the list. Avoid the bottom of the list. Q4, the end of the year, is not the time to think about sector rotation. The beginning of next year would be, but the end of the year is not. So keep in mind where we are looking for follow through. Really matters. Everything is not going to follow through in the same manner. And if we can start to build watch lists that prioritize names that have the highest follow through, we're going to have usually a better shot at taking profits off the table, right? And we have a better shot of seeing not one day of performance, but rather, days, if not weeks of performance. We want to avoid chop, and we want to focus on that trend. All right. The next question is for Affirm. Eddie, what are my thoughts on Affirm? It's an uptrend, but I can't do anything up here at 64. Obviously I need a pullback. So what would a pullback look like? Again, it's a trend, so that's cool. I'm focusing on something strong. And then I would pull retracements in the last major move. And this works. You just saw it on Dallas. You saw it on Delta Airline. Here's another example of that same process. Minor high to minor low, which is pretty cool, right? Arrow to arrow. So this is how I can have a consistent way rather than, look, I see a lot of people pull retracements, and most of the time it's fairly hilarious because they know what they're looking for. I try to really automate things because, look, my indicators just say this is where the minor low is, this is where the minor high is, and that's what you're going to draw the Fibonacci or the retracement or the Pingala. You're going to draw that Pingala retracement based on a consistent manner in which to find those turning points. And then boom, just like DAL. So if you're wondering, what do I do if I don't get a mean reversion? What do I do if I do not have a daily price movement range indicator running on a particular symbol? Look at the last major move. If it's a trend, wait for that 50%. It's just remarkably accurate. It will give you a really good entry. You got to wait though, right? Look how long we had to wait. Put the peak in on the 13th. It didn't pull back until the 15th. So I would have to wait for that all over again. And it works really, really well. I see a lot of creative Fibonacci drawings. For me, when we're looking at any kind of retracement, we got to look at expansion and contraction because that's really what Fibonacci analysis is. It's the mathematical reason things expand and contract the way they do. It's a law of nature, right? It's not a law of trading. It's a law of nature. So this indicator is a process. It's not even an indicator. This mathematical calculation is just a study of our nature. So if I'm looking at the last expansion or contraction for us in trading speak, it would be the last major move, the last major decline, or the last major rally. And this is the way that I find a consistent way of doing that. And again, whether it's DAL or AFRM, you'll see there it is. That's what I'm looking for. So hopefully that gives you something to think about to make retracement drawing really easy and to make it really process driven rather than, I kind of want this support level to work. The brain knows where to sort of pull it and it becomes incredibly subjective and then decreasingly accurate. All right. NASDAQ continues to hold on to pretty decent support. I don't necessarily look at the NASDAQ in the same way that I like the S&P. I like the S&P a little bit more. I like the Dow, probably somewhere in the middle. If you're wondering, hey, Rog, could there be a 50% here? Sure. Look, I think a lot of times traders forget that unless it works on everything, it really works on nothing. This notion of curve fitting, this notion of, hey, there needs to be a setting change every quarter, every month. The way in which the data is processed needs to change, needs to be updated. That's curve fitting. That's looking back and saying, gosh, if I would have sped up the slow stochastic, it would have given me a better result the last 3 months. If I would have slowed down the MACD, it would have given me a better result. So amateur indicator builders look back and say, oh, that worked better. And so they curve fit, not knowing that chances are that previous setting's probably not going to work forward. So be careful. There's so many subjectivity traps in trading. There's so many things that we as humans tend to do where are we bullish because we're long, which is what most traders and investors are, or are we long because we're bullish? And we always want to be the latter. A lot of times the sentiment a trader has about the market completely reflects their open positions, which is probably why I get so much grief when I keep talking about the equity markets moving higher. But I'm not looking to be right. I'm just looking to make money. And the long side has been that side, right? All right. So in terms of any one of these processes, there's your minor low to minor high. There's your 50%, tagged it yesterday, right? Pretty cool, right? And really easy, It's a classic pattern. I learned this pattern back in the late 80s, and that's what it is. It's a 3-candle pattern, minor low. I teach this in the room. You'll notice the Darvis 3.0 also does it automatically. So there's your minor high, and there's your minor low. And all it is if it's a minor low, it's a lower low surrounded by 2 higher lows, right? And if it's a minor high, it's a higher high surrounded by 2 lower highs. So you get a pattern that kind of looks like this. Kind of looks like that. All right, that's all. That's all that it is. It's a price pattern. That's the important part there. It's the price pattern, not a chart pattern. I don't look at chart patterns. To me, I did once upon a time. To me, chart patterns are the equivalent of looking at the sky. Rod, can you find a fox? I'll find a fox. I'll find a bunny. I'll find a dragon. The brain will make that work. Just as I see the very creative ways in which people say, hey, there's a pattern here. Be very careful. I abandoned chart patterns a long time ago. Again, subjectivity. Try some price patterns, and I don't think you'll go back. It just makes things very, very black and white. And we live in a lot of gray when it comes to trading. So the more objective we can make things, the more we can automate things, the more we let our system, our platform crunch the numbers for us, it increases speed, it increases accuracy, and it removes subjectivity in terms of looking for the things that we want to see. Because, my platform, TradingView, Toss, it's just saying, hey, Rog, this is what you programmed me to find. And whether you like it or not, here it is. Yeah. All right. So that's what we've got going on this morning. I will continue to be bullish, as I've been talking about, for 11 months. But where we are bullish matters. If you haven't already watched the video from yesterday where I talked about the sectors that are leading, please do. And you'll see where it is. I'm looking for those next set of opportunities as we round out the year. All right, gang. In the meantime, as always, be good to each other. We have 3 major hot zones coming up, 3 FOMC speakers coming up this week. Not a lot of data releases that are going to be super important, but we do have a few that we need to keep an eye on. So if you haven't already gone over to somewhere like Forex Factory or Trading Economics, please do. You'll see tomorrow, Thursday, our typical unemployment claims. But then we go into existing home sales, which is an important one to keep an eye on. And then more FOMC speak. Friday, we're probably going to have the most important of any of the data likely this week, arguably, which is going to be, as you see right here, the University of Michigan consumer sentiment and inflation expectations. And then we've got, Bowman, but after the bell. That's Friday. So thankfully after the bell. Be good to each other, gang. I'll talk with you soon.